Welcome. Today we're going to talk about a very prominent inflation hawk, someone who has been predicting high inflation for a long time and has been advising people to buy gold. And by that, I'm referring to Peter Schiff. Now, don't get me wrong, I actually have been a fan of Peter Schiff's for a long time because he was right about a lot of things over a decade ago. He predicted the housing bust of 2008 before it happened, as did I, as we will cover in another video going back to my blog archives. But he predicted it accurately, and people in the financial media were making fun of him for his prediction, and as far as I know, they did not own up to that when he turned out to be right. They did not apologize to him. He also has done very useful work in exposing that universities are not a good value for money and that most students do not benefit from going to college anymore. And he had a radio show, I think, that was devoted to that and other topics, and he did a lot of good work over there. So I was a fan of Peter Schiff for a long time, and I still am, but on the issue of quantitative easing, central bank monetary creation, what can unofficially and somewhat inaccurately be called money printing, he is completely wrong, and we will explore why that is, and I hope to even attract some of his attention to this video. So without further ado, I'm going to play a clip of him appearing on a financial news talk show, and we will analyze his statements and run through some of the key points about why he's incorrect to think that Federal Reserve quantitative easing is a reason to pile into commodities like gold and silver.
There's a good chance that there will be a toll.
Yeah, but then how do you account for the fact that we have gold sort of hovering at the 1730 levels, has dropped below 1800 as we're getting yet another round of stimulus, more and more reasons to back up your argument, but we're not seeing that movement in gold? Is that because, to your point, people still just have all this faith in the Fed?
Absolutely. I mean, that's the point, is that people are looking at all this monetary policy, all this inflation of the money supply. They're seeing all these cost increases. They can say it's because of supply bottlenecks or shortages, but that's always the case. If you print too much money, there's a shortage of everything because printing money doesn't create products. Creating products is what enables consumption. Printing money doesn't enable anything. It just lets you bid up prices. So you can always blame it on a shortage of goods, but it's a surplus of money that is the problem. But yes, during COVID, there was a reduction too. So we compounded the problem. But the reason that you're not seeing a lot more money going into gold, especially the bigger institutional money, is yes, they do not yet perceive the threat. They think everything is fine. They believe Powell when he says inflation is transitory. So they're not as concerned. They just like they believe Powell or the other Fed chairs, Bernanke or Yellen, when they said, "Oh, QE is only temporary. Oh, we're going to shrink our balance sheet back down to pre-crisis levels. Oh, we're going to normalize interest rates." These were all lies that the Fed told, yet the markets believed the Fed, and now they're telling more lies, but the markets continue to believe every lie the Fed tells, and they don't look back at their track record and say, "Hey, these guys haven't really been honest in the past." Now, again, maybe it's not honest. Maybe they're just wrong. Maybe the Fed is just wrong in everything it says. If it's just wrong all the time, well, then why believe them now if their track record is they've always gotten it wrong? Why would they believe that now they're suddenly going to get it right? But I do think that at some point, and I don't know when that point is going to come, but I don't think we're that far off, more and more people are going to start to doubt the Fed. The Fed is going to start losing a lot of its credibility, especially as inflation continues to pick up and the Fed continues to dismiss, any concerns by holding steadfast to this idea that there's nothing to worry about, that it's transitory. So at some point, people are going to call the Fed's bluff, like, okay, you can't do anything about all this inflation, and then gold's going to take off, right? So the opportunity now is that while most people don't perceive the threat and are just acting as if everything is fine and investing as if inflation isn't a concern, that's why gold is a bargain, and silver too, for that matter, for all the people that do understand where this is headed and can think ahead of the curve, right? So people who are watching Kitco, right, we can all load up on gold and silver and these type of stocks, But the people who just watch Bloomberg and they don't hear these type of discussions, they have no idea. So by the time Bloomberg's audience starts buying gold, the price is going to be much, much higher. And maybe there'll even be a toll.
Oh, wow. Well, speaking of tolls, taxes, and the like, and former Fed chairs and current Treasury Secretary, well, Yellen has been hinting, quite aggressively actually, that she expects changes in tax policies. She's also hinting that there'll be some, quote,
now, to unpack everything Peter Schiff said in that video and to explain why he is wrong, there are 3 key points. So let's start with the first one. Monetary creation, unofficially known as printing, offsets technological deflation, which is exponentially rising. People who have read my material for a long time know about this already, but let me just illustrate this in a certain way. This is how you track world central bank monetary creation. Scrolling down here, and these are the 4 major central banks of the world, which are not the entirety of world money printing. It's maybe 85% comprised of these 4. The US Federal Reserve, the European Central Bank, the Bank of Japan, and People's Bank of China. These are the trillions of dollars that each has done, and these are the years that they have done it with. And this chart will be important in even the second reason why Peter Schiff is wrong, but sticking with the first one, if we add up these 4 combined, we get this chart. Notice the smooth exponential curve and how it is $29 trillion to date just from these 4 central banks. And these are the years. So it's been going on for about 11 years now, and there's still no evidence of inflation because technology is rising as a percentage of the total economy. All technology is inherently deflationary, and high tech, which I define as something that is improving at more than 10% a year for the same result, as in you get the same thing for a price that drops at least 10% a year on a compounded basis. That is now 3% of the entire world's economy. It was only 2% by 2016, 1% 2008, 0.5% in 2000. And it has only begun to start distorting traditional economic thought and outdated economic metrics very recently. But to those of us who understand technology and the accelerating rate of change, it is very obvious that the amount of money printing you would have to do just to offset this deflation will necessarily rise exponentially. In 2011, the most that the world could absorb without inflation was maybe $75 to $100 billion a month. By 2021, irrespective of the coronavirus crisis, that number is now $400 billion a month. And in 7 to 10 years, that number will be much higher still. It will be well above $1 trillion a month that can be printed without inflation. And that is a wonderful thing because the asset values of the world will continue to rise. Now, if there's a small inflation blip just because of the severity or the gusher of printing that's been done recently, let me tell you where to look for that. This is the same chart converted to year-over-year percentage gains. My atom thesis of how this money printing offsets technological deflation accounts for a compounded annual growth rate ceiling of 16 to 24% a year. And it has rarely been in the zone of inflation for a full decade before this coronavirus crisis. But now, year over year, there's 46.3% growth in the cumulative amount of money printing because 10 trillion has been done just in the last year. Now, 46.3 is well above the upper bound of what I described of 24%. So there could be some very short-term inflation where a lot of people, including Peter Schiff, will come out of the woodwork, but that will last for a super short time because even a small pause in the rate of monetary creation, the rate of quantitative easing, will easily bring this number back down to 24% because it's a very steep compound annual growth rate to have to keep up with. So aside from some very short-term blips, as long as this chart stays above 24%, that is the only time there might be a little bit of inflation, which still has not happened yet. But once it gets back to 24%, the very temporary inflation blip will dissipate just as fast as it came. Now going back to the reasons why Peter Schiff is wrong. The second reason, which we also saw the reason for in the World Quantitative Easing report that we just looked at, monetary creation is borderless. The US Federal Reserve is only about 25% of total world creation to date. He's still talking about the US Federal Reserve as if America is the only country in the world and how US money printing will cause inflation. Well, even if the US stopped money printing, that would be just 1/4 of total printing. if the other central banks were doing the same amount, that is still 75% of world printing. So trying to front run the US Federal Reserve in terms of making investment decisions is not a sound strategy, because that is only 25% of whatever you're trying to actually front run. So both of these points are accounted for within the report we just saw. Money printing is borderless. There is a world outside of the United States, and from what we saw in the chart earlier, the central bank that is currently doing the most is the European Central Bank. Now, you would think Peter Schiff would know about this, because the name of his asset management company is Euro-Pacific Growth Fund. Euro-Pacific. So that presumes he has an international outlook, but in terms of the effect of money printing, he is curiously looking at just US money printing while worrying about the price of something that's priced internationally, such as gold or silver. So second mismatch over there. And I hope he sees this video and rectifies his investment strategy before he actually loses money. For someone who's run a company called Euro-Pacific Asset Management for a very long time, you would think he would have a more global outlook on monetary creation and how it is borderless, and only the grand total worldwide is what matters, because all technology is borderless and commodity prices are borderless. And this brings us to the third reason that he is wrong. Even if you think inflation is going to happen, such as the reason I just gave, that the year-over-year growth rate and the amount of cumulative monetary creation is now well above 24%. So even if you think there's going to be some inflation, gold and silver are terrible hedges for inflation, and the last 11 plus years of results have actually proven that. Why are they terrible hedges? Because technology always finds new supply. Why is it that when people were talking about peak oil, those who understood technology knew that the price of oil was going to trend downward, because when the price was so high, there's enough of an incentive to create innovation for alternatives. And what I've written about in my framework is that the atom thesis shows that the medium of technology existing in the world gets more and more powerful. The oil spike in 1973 could not have created new supply very quickly, but the oil spike from 2007 to 2014 was at a much later stage. World technology was much more powerful, and new supply was created very quickly. And I have a very famous prediction that I made at the start of 2011 that we'll look at in another video. The same is true for gold and silver. As the price rises a little bit, there is incentive to produce more supply. And there are many things that already produce more supply. For example, drones up in Yukon Territory and Alaska are able to shoot electrical pulses that identify where gold ore is, and therefore reduce the cost of prospecting for gold by a factor of 100. So they know exactly where to look for where the gold ore is. They don't have to painstakingly examine all the land in that frigid, mountainous, dangerous location. Similarly, asteroid mining, which is not yet possible but will be possible in 15, 20 years or whatever, can increase the supply of gold, silver, and platinum tremendously. They already know which asteroids have a fair amount of supply of these so-called precious metals on Earth, and it is a matter of time before we can simply access these precious metals for supply. So as more money is printed, the supposed increase in price of any commodity merely draws more of the world tectonic medium to increase its supply. And what Peter Schiff said that was also incorrect was that printing money doesn't create products, and then there's too much money chasing the same products. Well, that's not really true either. As you print more money, there is more financing available to fund innovation in new types of products or advanced versions of existing products, which in turn generate more deflation. Plus, software does not have inventory issue. That's why his mindset is still in a pre-technology world. If 1 million copies of a certain type of software are sold, there was no inventory, there's no shortage, there's nothing forcing the price upwards just because there is not an inventory or a shortage concept to software. Now, the software vendor may try to increase prices just because they have that pricing power, but then competitors also come in. Video game prices are in fact lower than they were 30 years ago or even 15 years ago when you had to buy them on CD-ROM or DVD-ROM. Now that video games are downloaded, the actual average retail price of video games played on PCs or PlayStations or Xboxes is in fact lower. And we will finish off with a visit to a chart on commodity prices for the last 11 years. This is a chart of the broadest index of commodity prices known as the Goldman Sachs Commodity Index, the GSCI. And I put this caption on the chart, obviously, but this is the price over the entirety of quantitative easing. We just saw earlier in this video that $30 trillion of quantitative easing has been done over the last 11 years, and the price of all commodities combined, gold and silver being major components of this index, has been trending downwards. It's actually lower than it was 11 years ago. There are certain ebbs and flows, obviously, but it has been trending downwards even in the face of $30 trillion of quantitative easing. Now, for those who understand technology and understand what I just described in this video, this is no surprise at all. The NASDAQ 100, the tech-heavy stock index, predictably just goes higher and higher based on the amount of quantitative easing, while commodity prices fail to keep up. They might go up a little bit here and there, but the trend line is certainly downwards. So Peter Schiff, assuming that all this U.S. Federal Reserve money printing will actually cause inflation, and that's why he is long in gold, is probably losing money and has been for a very long time, simply because he is brilliant in most matters of finance, but he just does not understand technology and the new economics of technology, which is what one of the major themes of this channel is. And don't get me wrong, I'm not saying Peter Schiff is anywhere near the category of those PhD economist eggheads. Peter Schiff runs an asset management company, which means he's accountable for the results, and he's been in business for a long time, so obviously still does a lot of things well, as opposed to those PhD economists who are never accountable to anyone and only interact with other PhD economists, so they don't mind that their prediction rate is virtually 0% accuracy. They are 0 for life on all major predictions, and they don't even find that to be wrong because everyone else they also know is identical to them. So he is not in their category of wrongheadedness. Peter Schiff just needs a small tweak in his understanding of technology because he is a finance guy who is not also a technology guy. So I say that in friendship, and I hope he and I can speak about this at some point, or even have a lively gentleman's debate that we can post on YouTube. So I hope this video was enlightening. If you like this type of content, please hit the upvote button and subscribe to this channel. I guarantee you will end up healthier, wealthier, and wiser from doing so. Thank you for watching.